Okay, so we focusing on investment and portfolio management, Unit 1, and we looking at the introduction to investment, specific issues that we will be um, considering is that we need to know what investment is all about and what portfolio construction can be done or how it can be done. So when you talk about investment, what generally would we consider as an investment? If you, what again do we mean by the term portfolio, and how do you construct portfolio? Whilst doing that, what investment goals must you specify? Okay. We also be looking at distinction between terms like liquidity and marketability, the various forms of markets that are available, the concept of risk, and the sources of returns. These are the things that we are going to focus on as far as Unit 1 of investment and portfolio is concerned. So, having gone through this, we expect that at the end of the unit, we will be able to specify investment goals, and we can clearly distinguish between liquidity and marketability. All right. When it comes to investment, liquidity and marketability is very important terms. So we expect that at the end we would have understood, so we could do the distinction. What about primary and secondary market? Any distinction between them? Also, we have to be able to look at the differences. Then the concept of risk. What are the sources from which risk may come? What are the sources from which we may earn some returns on our investment? We will look at that. And finally, we would explain why financial markets are considered efficient. So in this context, we'll be looking at what we call efficient markets. And so we'll be looking at what efficient market is all about. Now, let us look at the need for planning and investing wisely. Investment is good, but it is not any undertaking or any venture at all that you have to invest your money. We have examples here. Microsoft Corporation, all right, within a space of 10 years, the stock price, okay, what we call the stock value, the share price or the stock value, as we may call it, had increased by 5,000%. So it means that if you were an investor and you had that foresight, or you did your calculations or your estimations and you did invest in Microsoft, it means that you are going to be 5,000% richer than prior periods to your investment. Again, world of wonders. After 10 years, the value was worth nothing. The value of the stock was worth nothing. World of wonders. All right. So it tells you that there's the need to plan before you invest. In Ghana, before UT Bank Demis, all right, prior to 2017, when the bank was taken over by Ghana Commercial Bank, the stock value, the share price of UT Bank was worth nothing. It was like somewhere around 10 pesos, just 10 pesos per share. So it tells you the extent to which the share price of that company fell. All right. So what it means is that when you are investing, there is a need for you to plan properly to know where your money or your funds will need to be invested. All right. Now, you also need to understand that planning for your investment is so important because the investment environment is so dynamic and it is being shaped by a host of factors such as technology. Technology is now dictating the pace of everything that we do, and that includes investment environment as well. So planning for investment and investing, we need to do proper planning and invest wisely because our investments are now being influenced by technology, inflation, recession. Recession, we're talking about the era or periods in the economic level or activities where the economy is not doing well. All right, that is what we talk about as recession. So in recessionary period, inflation is high, prices are skyrocketing, income levels of people are low, and a whole lot of things. Demand level is low. So generally, companies demand levels are low. They don't demand securities. And so when the demand is not forthcoming, most often the security price will drop in order to attract. So recession is one of the factors that define the dynamism of the Investment environment. Okay. And again, the investment environment is also characterized by what decline in stock prices. So owing to these factors, it is important and for you to do proper planning before you do your investment. Let us now look at for a portfolio construction. And it's important to note that once you receive your income as an individual, when you have your income, two things that you use your income for. The income here, we mean your disposable income, okay? You either spend it or you save it, or you may divide them according to any proportion you want. You may spend part of it and you may save part of it. So if the individual you choose to save, if you choose to save, then you have to go beyond that saving idea to make additional decision. And that decision leads to the question about what is to be done with the savings that you are going to do. And that brings home the idea of what? Investment. So here, savings and investment, we are using them interchangeably, but savings is not the same as investment. Take notice of that. But at this basic level, we are using them interchangeably. So the monies that you are saving, quote unquote, the monies that you are investing, what are you going to use them for? That means that we are bringing home the idea of your goals for investing, your objectives for undertaking an investment. So when you are constructing a portfolio, it is important for you to answer that question about why do I have to invest? Why is it that I am investing? Okay, what is the need for me to do the investment? So the saver must decide. When you ask that question and you're able to define your goal, then you have to decide where to invest. If you think that you are saving or you are investing to be able to purchase a car in 5 years' time, then you need to know which investment assets or which investment vehicles you have to put the money in. So where to invest in order for your goal to be what achieved. You need to ask yourself that particular question. Okay, so when you are constructing a portfolio, then it is believed that you are saving or you are investing. And so you must ask yourself why you want to save, why you want to invest. And that question would obviously lead you to deciding where you would, put your money. In effect, the saver must decide on a portfolio of assets to own. That is why I said that you need to know when you ask yourself and you know your investment goals, then you are able to tell which of the several investment vehicles or which of the several financial assets available that you will buy and own so that you'll be able to make returns over time in order to carry you to achieving that particular goal. In this context, a portfolio, the meaning of a portfolio simply means that when you combine different assets, okay, to serve as a store of value. So for example, I want to buy an asset in the next 10 years. I want to buy a house in the next 10 years. And I have done my estimation and I know that the house will be worth 150,000 Ghana cedis, or let's even say 300,000 Ghana cedis. Okay. Then what I will do is that I will now come back to decide that, okay, what assets do I have to invest in that at the end of the day, in 10 years time, I'll be able to make that money. If I decide to buy Fan Milk shares, if I decide to buy government bonds, number two, number three, if I decide to buy corporate bond, let's say Anglo Gold, I buy their corporate bond. These three, if I invest money, a lump sum money today into buying the stocks or securities that I have mentioned, then I have formed a portfolio because the monies that I have put in, I believe that those securities that I have purchased, they will store my money, okay? They will store my money and make it more valuable so that in 10 years to come, I will make enough money to be able to satisfy my need. So portfolio simply means that you are investing in more than one asset. You are investing in what? More than one asset. So poor management of these assets. So the various assets that you are buying to constitute the portfolio, okay, if you manage them poorly, then at the end of the day, you are only going to destroy the portfolio value. The management of the portfolio simply means that once I invest in those three assets I did mention, I don't have to go back to sleep. I have to monitor the performance, okay, of Anglo Gold corporate bond. I have to monitor the performance of Fan Milk share price. So is Fan Milk, their share price, is it increasing? Is it doing well? If it is not doing well, I can sell my shares in FanMilk and probably use the money to buy shares in MTN if I think MTN is rather doing better. Or I can reduce the investment I have made in FanMilk and I will withdraw a portion of it and invest more in the other assets that are performing well. So that is about the management. But then if I manage it poorly, then at the end of the whole investment cycle, the portfolio value, the returns that the whole portfolio will give me will be something insignificant. All right. So the individual will not achieve his or her investment goals if the portfolio is managed poorly. There are many assets, of course. If you want to form a portfolio, so many assets. Stocks simply talks about shares, so you can combine different shares, the shares of different companies, bonds, government bonds, corporate bonds. You can combine them. Derivatives like futures, swaps, options. We have so many types of derivatives. So when you want to form a portfolio, there are different financial assets available that you can decide to split your investment income into investing in them. All right. Understanding the nature of the long-term assets. So when you are forming a portfolio, you may want to look at whether you want to, even depending on your goal, then you may need to decide whether to invest in short-term assets or even long-term assets. All right. If you decide to add long-term securities, for example, shares, bonds, they are all long-term assets. Shares or stocks and bonds are all long-term assets. If you decide to invest in these securities, for example, then you have to understand their behavior. All right. You need to know how they are bought, how they are sold. If I want to buy shares, how do I buy it? If I want to sell some of my shares in this, for example, company stock, how do I sell it? So once you decide to form your portfolio by including or combining long-term assets, you need to know more about them. You need to understand them. So have an idea about where to buy, where to sell them, how to buy, how to sell them. Okay, how are they valued? If I want to determine the price, the market value of the stock, for example, the FanMilk shares I hold today, or MTN shares that I hold today, or AngloGold corporate bond that I have purchased. I have purchased it 5 years down the lane now. 5 years ago, I bought it. Today, how much is the value? Today, how much is the worth of that bond I bought 5 years ago? So you need to know how to value the security. Why? And so you know how to value them. How then do you determine the overall value of your portfolio at any material point in time? So it is important that you have appreciation of all these things. And that is exactly what this course leads us to do. Again, how they may be used in portfolio construction. So that is it. So these are the primary focus of this course, and that is what we're going to be looking at. Factors that affect construction of your portfolio. So when you are constructing your portfolio, remember I have said that portfolio talks about combining more than one asset, okay, two or more assets, investing in more than one asset or investing in two or more assets. And for that matter, capitalizing on it to store value for you in the future. So when you want to invest or split your investment income into buying more than one asset, the question you ask yourself, okay, is what factors must I consider? What factors must I consider? This is very important for your even section B or assessment is very important. So one, the most important thing is your goal. Why are you constructing this portfolio? You are constructing this portfolio, you are investing in these classes of assets for what reason? What is your agenda? So the goal of the investor is the most important objective or the most important factor to consider whenever you want to construct a portfolio. Number two, look at the risk involved in bringing those assets together. There are some assets that if you bring them together, the risk of the portfolio that you are going to construct will be so high. Why? Because there are some assets whose returns move together. So you have to invest in assets that are dissimilar, or you don't have to invest in securities that belong to the same industry. Otherwise, when that industry is not doing well, all those securities that form the portfolio will not be doing well. So you need to, consider the risk of that portfolio or the risk associated with the individual assets that you are combining to form the portfolio. You also have to look at the taxes that will be imposed There are some countries that whatever returns that you make, be it in dividend that you receive or be it capital gains, they are taxed. Okay. Yeah. So you look at the tax bracket in which, as an investor, you find yourself. So you may want to look at assets that are less taxed or that are not taxed, so that you take advantage of the differences in the tax administration of the assets that you want to combine. Another important factor that you would have to consider is the knowledge of the available opportunities and alternative investment. So these are the assets that I am considering. These are the investment, the financial asset that I'm considering. Okay. Aside these ones, are there alternative assets that if I choose not to invest in these ones, I could redirect my financial resources to? Okay. If I choose not to invest in these three financial assets, could I go to real estate? How much knowledge do I know about real estate, investing in that? How much knowledge do I know about investing in real assets, like investing in machineries and other things? So these are all important factors that you need to know when you are constructing your portfolio. And selecting an investment. So whenever you are selecting an investment, the most important factor is, what is your investment goal? Okay. That's the first thing that you have to ask yourself. The first question you ask yourself is that, what is my investment goal? What is my investment goal? So we keep on saying this. We keep on saying this. So several important questions need to be answered in order for you to come to the conclusion that this is my investment goal. One, you ask your question whether you want to be an active investor. An active investor is that investor who is always busily managing his investment. He doesn't put money into that investment and go back to sit down and expect the investment to be yielding. And if you do that, you are rather a passive. If you invest in any venture or any financial asset and you go back to sleep and you expect that whatever the asset will perform, you leave it to chance, then you are a passive investor. So you need to ask yourself, if you want to be an active investor is the one who monitors the performance of each of the assets within the portfolio and see which one is not doing well, and for that matter, selling them or reducing the investment in them, pushing in more money into those that are doing well, in order to maximize the returns of the entire portfolio. So you ask yourself, if you want to be an active investor, then do you like taking risk? We have people who are risk lovers. We can also call them risk seekers, So if you are that type, if you are a risk lover, it will tell that you are probably more likely to invest in assets that are risky in nature. For example, corporate bonds are more risky than government bonds. All right. Stocks are more risky than treasury securities like treasury bill. All right. So if you were a risk lover, then it will also tell the kind of investment assets that you select to form your portfolio. However, the average investor is risk averse. Risk averse investor is the one who does not, entertain risk at all. He will only invest if there is sufficient evidence that he's going to make some stable returns. Are you getting it? So you need to know if you are willing to take risks or not. Then again, are you looking for a current return, or you are rather interested in price appreciation? So when you are, setting your investment objective, these are the questions you ask yourself. Number one, do you want to be an active investor? Are you willing to take risk? Okay. Number three, you ask yourself, am I interested in current income, or I am rather interested in current appreciation? For example, if you were a pensioner and you are investing, you'll be interested in current income, because as pensioners, they are not working, but they are spending, isn't it? So what they need is what? Investing in securities that will produce income very quickly. That is why most pensioners will buy government bonds, because after all, at the end of a specific period, either quarterly or, as the case may be, or semi-annually, they know that the dividends will start coming in or tripping in. The interest the government will be paying on the bonds will come to them. So current income. So as an investor, you need to ask yourself whether you are interested in current income or you are interested in price appreciation. Price appreciation is what we call the capital gain. There are some investors that they are not interested in current income, receiving income today, but they want to invest in an asset, hoping that the asset will increase in net value. For example, you buy an asset worth 10 cedis today. You hope that the asset in 3, 4, 5 years to come, the asset will sell at 100 Ghana cedis, so that you have made 90 Ghana cedis worth as returns in monetary terms. So if you are interested in capital appreciation or price appreciation, then it means that you are not interested in making or going in for securities that are paying interest on the short term like treasury bill. You are rather likely to go in for assets whose value is most likely to appreciate, like the stocks and then the bonds, corporate bonds, as the case may be. So these are the 3 key factors that one would have to consider when you want to set investment goal. And of course, we have said that determining your investment goal is the most important activity that you have to do whenever you are selecting an investment or an asset to form your portfolio. Now, let's look at the goals, which means that the reasons for investing. We have talked about that. Setting a concrete and realistic investment goal is considered by many experts to be the single most important step in investment process. So the whole investment process, the setting of investment goal is the most important objective or is the most important step in the entire process, is the most important step of the entire process. Because if you don't know the reason you are doing the investing, then you wouldn't know even the type of asset to select and invest in. Okay, so it's important. Below are some of the important investment goals. So if you don't have or you are not clear about what goals you are seeking for, here are some of them. Meeting liquidity needs. Meeting liquidity needs. Most people invest, okay, because they need cash. Liquidity is talking about cash, laying your hands on cash so quickly. You pay bills, you pay school fees, isn't it? So some people invest in treasury bills and those kind of things for liquidity's sake. Liquidity's sake simply because treasury bill will be paying the interest income very rapidly. So as and when those things come in, they'll be using to settle their bills as and when they pile up, right? So one main reason why one would want to invest is to meet their short-term liquidity needs, okay, because they are always spending on a couple of things, and so they need money from time to time to be able to sort themselves out on those stuffs. So that is one of the important objectives. Another one is saving for large expenditure like buying a house, building, or engaging in a massive project. So that's another investment objective. Retirement planning. People, even in their 40s, in their 30s, they are investing and hoping that they will liquidate everything in 20 years' time, in 30 years' time, when they would have gone on retirement. So retirement planning is another important reason why one would want to enter into what? Investment. It's very, very important. It's very, very important. So let's take notice of that. So let's look at a couple of definitions that are associated with investment. All right. So some of the definitions are a bit awkward. Some are interesting, and so some uses jargons such as bull or bear. We will meet in some of these words as and when we progress. Then we will be meeting other definitions like primary and secondary markets. We will look at some of them. Then we also look at some of the terms are a bit confusing and not too straightforward, so that when you look at them, until you wouldn't know exactly what those terms are represented. For example, if you say purchasing power risk, it is not a term as so easily to be understood like the primary and the secondary market. All right. So these are some of the terms that we will be looking at. First of all, let us look at what investment mean. What investment mean? All right. Let us look at investment from the perspective of economics, and we will look at it from a layman's point of view. From the academic point of view or from the economic point of view, investment can be looked at as buying physical assets, okay, such as a firm buying physical assets like plants, equipment, or even inventory. All right. So firms' purchase of physical asset is part of the definition of investment as per economics. Again, the economic definition of investment also applies to purchases that are done by individuals. For example, if individual, you buy a new home. So if an economic person says investment, he is not referring to financial asset. He's referring to what? Physical asset that are purchased by businesses or individuals, period. So to the economist, if you say investment, it is different from the finance person saying of investment. Okay, so in economics, you say investment, we are talking about the tangibles. But if in finance, we say investment, we are referring to the purchase, the sale and the purchase of what? The financial assets. Those financial assets that only exist in names. You can't see them. For example, bonds are terms that just exist in names. Stocks like shares, they only exist in names. They are not physical creation. Are you getting it? So they are just legal arrangement that they don't exist in any physical form or shape. So that is what we mean by investment from economic and finance perspective. So from the economic perspective, investment talks about purchasing of what? Physical assets, either by businesses or individuals. From the finance perspective, investment is talking about what? Purchasing or selling or, trading in these financial assets that are purely legal creation, right? To the layperson, the word investment denotes buying of what? Stock. So the layman's point of understanding investment is more of the finance perspective. So to a layperson, we talk about I am investing, he's thinking about buying these financial assets such as stocks and what? Bonds. All right. Yeah. It does not, necessarily apply to these physical assets like equipment, plants, or machineries. So to a layperson, when we talk about investment, he's not talking about the finance. Sorry, it's not talking about it from the economic perspective, but it's talking about from the finance perspective. Okay, that is what investment is about. When you talk about primary market, this is the market where newly issued securities are traded. So if securities, for example, bonds or shares are issued for the first time, anyhow, anywhere that they are traded, the most important thing is that the security is freshly issued one. So wherever they are sold, that place where they are traded is called primary market. If you talk about secondary market, it's like a second-hand market where already existing securities are traded. For example, if I hold MTN shares and I am in need of money and I want to sell some of the shares, wherever I will decide to sell the shares or trade the shares for money, we call it secondary market. Remember, if securities are traded on the primary market, whatever monies that are generated goes to the firm that issues that security. But if securities are traded on the secondary market, then because the securities are rather in the hands of the investors, whatever money that are generated, it doesn't go to the company that issued the security. The money goes to what? The investor who sold or who traded that asset. Valuation simply talks about, it's another term, of course, that talks about the procedure that we follow in estimating or assessing the value, the worth, or the price of a security. So the value of an asset is simply talking about what? The price, how much an investment or an asset is worth. So the process of the arriving at the value of an asset is what we call valuation. When you talk about returns, we are talking about what you are going to earn after you have invested in an asset, whether financial or real. So the earnings that you are going to make, okay, is what we call the returns. Income normally manifests in two forms. When you invest, you are going to receive income, and the income is always either it is in the form of dividend or it is in the form of what? Interest. But we may have a third called the capital gain, okay, the capital gain. So that is another income. So incomes are normally in three forms: dividend, interest, or capital gains. Then we have that capital gains. The meaning of the capital gain talk about appreciation in the price of an asset. So if you bought an asset today for keep, you bought it 10 cedis, you bought shares 10 cedis, a year's time, the share is selling at 15 cedis. It means you've made capital gain of 5 cedis. So that 5 cedis is part of your income. So these are some of the terms that you need to know. More terms: one, rate of return. Rate of return simply talks about the earnings that you are going to make expressed in a percentage form, the earnings that you are going to make. The earnings is the same as the returns that you are going to make, but then we express it in percentage form. That gives us what we call the rate of return. Then risk simply talks about the uncertainty, okay, that the anticipated return will not be achieved. Normally, when you are investing, you anticipate that you are going to attain a return of 15% on your investment, okay? So for example, if you have invested 100 Ghana cedis, you expect that at the end of a year, you are going to make 15 cedis more. That's 15%. You are going to make 15 cedis more. So the probability that that 15 cedis you had anticipated will not be realized, the probability that that 15% will not come, what will come will be something other than 15%, is what we call risk. Risk is not necessarily a bad thing, because if you have anticipated returns of 15% and you are not going to get it, the probability that you are not going to get it means that you may get something less or you may get something more. So when you talk about risk, we have a positive outlook and we have its negative what? Outlook. The negative outlook is when there's a chance that you get something less than 15. The positive outlook is where there's a chance that you get something more than 15. In either case, it is risk, because we are looking at the probability that you get something other than what you had anticipated. That is what we call risk. So the uncertainty that the anticipated return will not be what achieved. Then when we talk about speculation, it implies that the investor runs a good chance. So speculation is all about the chance of losing the funds that you have invested in the speculative what? Asset. That is speculation. So when you are speculating, it is you are operating purely on the basis of what? Chance. You are taking chances on buying an asset and hoping that you will make a very abnormal returns within the shortest possible time. When you talk about marketability, very, very important. The last two, marketability, liquidity, very important. Marketability simply talks about how easy it is, okay, or how tradable an asset is. That is to say that the asset can be bought or sold. How easy can you trade the asset? Trade the asset simply means that buying and selling. If it is easy for an asset to buy and sell, then it is marketable. Okay. If it is easy for an asset to be bought and sold, then it is so marketable. So many financial assets, such as the stock of Microsoft company, it is very marketable because that company's shares is very vibrant. The company is vibrant. They always make a lot of profit. And so it is easy for most investors are, investing in such. So they're always buying and selling, buying and selling. So if it is easy for an asset to be traded, bought or sold, then it is marketable. Then liquidity, on the other hand, talks about how easy it is for me to convert a non-cash asset into cash without the risk of what? Loss. If I have an asset, a non-cash asset, for example, I own some shares, okay? Shares of AngloGold, I hold shares in Unilever, and I want to sell. Is it easy? How easy? How quickly can I sell my shares without losing money? All right. That is what we call liquidity. Take notice of that. That if you define liquidity as the ease of converting an asset into cash, if you stop just there, you have not defined liquidity. For you to fully conclude it, you have to add without the risk of what? Loss. Without the risk of what? Loss. In fact, almost every asset, if you reduce the price, you can easily sell it. For example, if you have a car and the standard price is 500,000 Ghana cedis, if you reduce the price to 100,000 Ghana cedis today, immediately within some few seconds or few minutes, you'll get a buyer. It doesn't make that situation is not liquidity, because you have been reducing the price from 500,000 to 100,000 Ghana cedis. You've been able to sell the car, all right, but look at how much money you have lost. That is not what we call liquidity. So for we to say that an asset is liquid, we should be able to quickly sell it without losing that substantial money or without losing that huge money, like the situation I gave. Are you getting it? So without the risk of what? Loss. That should be liquidity. Then an investment, the term investment versus speculation. What is the difference between investment and speculation? An investment is a commitment of funds made in an expectation of some positive rate of return. Whenever you make an investment, the expectation is that the returns you will get is what? Positive. all right? And it is a firm commitment that you make in funds. You commit some funds into some asset, and you have that positive outlook. You have that positive expectation that you are going to make a return that will be positive. Okay. If the investment is properly undertaken, the return will commensurate the risk that the investor assumes. So in the case of investment, we believe that the returns commensurate with what? The risk. That is another important thing about investment that you need to know. So if only the situation is investment, then for an investment, returns and risk, they go hand in hand, they match, they commensurate. In other words, the returns you will get is in proportion of what? Is in proportion of how much risk you have taken. That is why we say that in a perfect capital market, the higher the risk, the higher the returns. So those who take more risk, they are, rewarded more. The returns they make is higher. Those who take less risk, the return they make is less. So if it is investment, then we believe that the returns commensurate to what the risk that have been taken. Now, what about speculation? We say that investment are distinguished from speculation by one, time. So the key difference about investment and speculation can be made or can be drawn. We can draw the difference between investment and speculation on the basis of what? Time. So when we talk about investment, generally the time is over a longer period, generally speaking. But speculation is just for a short while. You have spotted some mispricing somewhere. You've seen that an asset is undervalued. An asset is selling cheap. So you buy it cheap and you wait for a while. When the price goes up, you sell it higher, then off you go. That becomes speculation. So with speculation, the time horizon is normally short compared to investment, where the time horizon is expansive. And again, it's often by the return risk characteristics of the investment. Again, if it is investment, then the risk and return characteristics are always there. Risk commensurate the return. Okay, how much risk you take is a commensurative of what? The returns that you make, as we have indicated. Now, the true investor is interested in good rate of return and on a rather consistent basis over a long period of time. So remember I said, when it comes to investment, the duration is longer and the returns we expect is positive, right? And we expect it to be consistent. For example, positive means that the returns we are hoping to receive should not be negative for all the years that we are waiting for. The speculator seeks, on the other hand, this is a speculator, he seeks opportunities that promises very large returns. So for the speculator, the returns that he is seeking for is so abnormal, very large return. And normally that returns he wants it so quickly, he can't wait. That is a speculator. The speculator is less interested in consistent performance. Okay, he's less interested in consistent performance and is more interested in abnormal or extremely high returns. We have just said that. The speculator wants to get these high returns in a short time. So these are the main differences between speculator and or speculation and what? Investment. It is very important. So with respect to the speculation or speculator, he is interested in abnormal returns over a relatively shorter period of time. So let's take this for example. Unilever is generally considered to be a large and a strong company. The share price of Unilever should, over a long period of time, improve steadily in line with the strength of the economy. If, however, a speculator feels that the company's share price is 600 and this 600 is too low, if the speculator thinks that, oh, Unilever's share price is cheap, the company is selling it price cheap, 600 is very cheap, I believe that the market will correct and it will go up very, very soon. So before they correct their mistake, let me go and buy the shares of this company at the 600 so that when they correct it and in future they are selling it higher, I will sell it at that 700. Then that becomes a speculation. Okay, then the activities is that of a speculator. When you spot that an asset is mispriced, you are not buying that asset because you want to keep it over a long period of time and patiently receive the positive returns. That is not why you are buying. You are buying because you have spotted an opportunity which you can exploit within a short while. Therefore, you are buying to be able to exploit that opportunity. Then you are a speculator. So that investor who is buying the Unilever stock is not concerned about the growth, the long-term growth, or the dividend prospect that the company can pay him. No, he's only seeing that he sees the possibility of making 100 cedis profit within the few days or few months. And so he's buying, and the moment he gets that opportunity realized, he doesn't continue again. All right. Unless similar opportunity emerges. So his only concern is with the potential short-term price appreciation. So the moment he is able to extract that short-term price appreciation, then he's had his objective achieved. So he's gone. Now, despite his motivation, the speculator adds to the market liquidity and debt. So the activities of the speculators, yes, they are important, even though the activities operations are for a short while. They are important because they add to the liquidity situation and they add to the debt of what? The market. Why do we say this? He is frequently turning over or changing his portfolio. So for that investor, he is frequently selling and buying. And where in the whatever market where selling and buying or buying and selling is so frequent as per the activities of the speculators, then that activity helps that market to become liquid. The security sold in that market becomes what? Liquid. So yes, the activities are for a short while, but they really, really help when it comes to what? Liquidity situation of the market. And they help in the debt. The depth of a market is talking about the degree of trading, the volumes of trading that are done on that market. And because they buy and sell too quickly and very often, they help the volume of transaction to increase, and that is the debt aspect. That the presence of speculators provide a market for securities and a wider distribution of ownership of what? Securities. Okay. Let's now distinguish between marketability and liquidity. I think we've already talked about this, and I said that marketability talks about the ability for an asset to be bought and sold. Okay, how easy it is for me to buy and sell this. All right. So most people, when they are investing, they want to look at the liquidity. Sorry, they want to look at the marketability, because there are some companies that you buy their shares. If you want to sell, there is no one interested. So you have to hold it for life. No one is interested in buying. This means that security is not marketable. All right. So a savings account, for example, with a commercial bank is not marketable because the investor only withdraws the funds. He does not sell the savings account. So savings account, take notice of that. It can appear in your OBJ if it may, all right, be in that form. So savings account you have with any commercial bank, it is not marketable. We don't consider savings account as a marketable, asset. Yeah, because at the end of the day, the purpose is not to sell the account over to another person. You only use it as a means of withdrawing money, but it is liquid. It is not marketable, but it is liquid. Liquid simply means that whenever you want to, convert it from an account form to cash form, you are able. All right. So you can easily withdraw money from your savings account as and when you want it. And so that becomes more liquid, provided you have funds in that account. So it is liquid because a state insured savings account has virtually no risk or loss of what? Principal. So virtually there is no risk attached to your saving. And whenever you want to, withdraw money or have cash out of that account, you are easily able to do so without any loss, without any risk of what? Losing anything. Liquidity therefore applies to an asset that is readily convertible into cash without the investor sustaining a loss. So I have talked about that. Marketability, on the other hand, refers to how easy you can sell an asset or how easy you can even buy and sell an asset. That's marketability. Even if the sale results in the investor sustaining a loss. So for marketability, the focus is all about how easy it is for me to buy and sell. Even when buying at a loss or selling at a loss, we don't care. We are all interested in how easy it is for the sale to occur, how easy for the purchase to occur. That is what defines marketability. Sources of risk. Sources of risk. Remember, we've talked about risk as the uncertainty that the actual returns that will come will be different from the one you had expected. Remember, you said that whenever you invest, you have some expectation about certain returns that you want to receive, right? Okay. So at the end of the day, how much returns, the actual returns that has come. I was expecting 15, but what came is 11. What came was 20. So the fluctuation, the probability that what I am expecting, the actual one will be different from what I am expecting, is what we call the risk. And we have two main forms of risk. We can also call it variability. When you say something is variable, variability talks about fluctuations or differences between the two extreme returns, the expected and then actual. There are variability. If there is no variability or no difference, what I had expected is exactly the actual return that came, then there's no risk. But if what I am always expecting, what will come, is always different, then it means the risk associated with that is very high. So variability, the term variability is invariably called risk. The term variability is invariably called risk. Okay. We have two types of risks, and it's very important that you should know. We have two types of risk. We have systematic risk and we have unsystematic risk. Very, very important. Once you are doing a course like this, this is one of the most important things you dare not forget. One of the most important things that you dare not to forget. Systematic and unsystematic risk. What do we mean by systematic risk? This is those factors that affect the returns on all comparable investment. In fact, the word here is all, okay? All factors that affect every company. All means every. So the investment of everyone, the risk affect it all. The risk affect it all. So, for example, exchange rate, inflation, okay? Which firm, if inflation rate is so high, every single company in Ghana is affected by the high inflation. Are you getting it? Yes. So that is the kind of COVID-19. When COVID-19 came, every individual, every company is affected. So these kinds of risks that affect the entire market. So this rate does not affect some company and leave some company behind. It affects every company, every tradable assets, every financial, it affects everything. So those factors that affect all comparable assets or all investment, or that affect the entire economy and anything that is within the economy, any company, any tradable asset that is within the economy, is what we call systematic risk, those factors. Let me, however, point out this, that even though we are saying that systematic risk, those factors that affect all comparable investment, but the sensitivity of that particular factor risk to various companies differ. For example, COVID-19 affected everyone, but the degree to which COVID-19, the extent of devastation to which COVID-19 affected firms operating in the food industry is different, or the extent to which COVID-19 affected firms operating in the pharmaceutical or health facilities is different from the degree to which COVID-19 affected those in the hospitality, like the hoteling, right? That is it. So even though systematic risks are those factors that affect all firms, all investment, all right, the sensitivity of that systematic risk to the stock of the various industries and various companies differ, meaning the impact are different. The impact are different. Some will feel high impact, high negative impact. Some will feel less negative impact. That is what, depending on the industry or the type of stock that you are having, that is systematic risk. So understand that systematic risk talks about those host of factors that serve as risk factors that affect all firms in the economy, that affect all tradable assets in the economy. Okay. So example, when the market as a whole rises, okay, the prices of most individual securities also rise. So the market as a whole, talking market here is the economy. So when the economy is doing well, then the share price of almost every firm in the economy will also rise. That is it. Okay. So it is a factor, the boom of the economy, can help prices to pick up, can help stock prices to pick up, right? Similarly, when the economy is in recession, every firm will be affected negatively and prices will begin to drop. So these are apparently what we call systematic risk. Now, because systematic risk affects every firm in the economy, diversification is not possible. Diversification is not possible. But first of all, what is the meaning of diversification or diversifying your portfolio? Diversification simply means that you are not putting all your eggs in one basket. Diversification simply means that you are spreading your investment income across, dissimilar assets, investing them in dissimilar assets. So you want to invest in real estate, firms in the real estate. You want to invest in firms in the services industry. You want to invest in firms in the assets of the manufacturing industry. So you have bought shares in firms manufacturing cement. You have bought shares of firms in the food industry, like Farm Milk. You have invested in the gold firms in the gold mining sector. So it means you have diversified. When it comes to systematic risk, because that risk affects all firms in the economy, even when you want to diversify, you will not make any gain. Because at the end of the day, all firms, the different areas you have invested, they are all suffering from that particular risk, because that risk has affected everywhere. So in the presence of systematic risk, diversification results in no better returns. Diversification does not reduce risk of the portfolio. Okay. Thus, because of the fact that systematic risks affect all industries, it affects all firms, and for that matter, diversifying will make no difference. We say that systematic risk is also called non-diversifiable risk, because whenever we have systematic risk in place and you diversify, there is zero gain you will make. You can't reduce your risk. The risk that you will have it or even more. So diversification does not reduce. Diversification does not reduce what? It does not reduce systematic risk. Because of that, systematic risk can also be called non-diversifiable risk. Meaning it is the type of risk that you cannot reduce by diversification. Simply put, it is that type of risk that you cannot reduce by what? Diversification. So take notice of that. The second one is what we call the unsystematic risk. The second type of risk, we call it unsystematic risk. Unsystematic risk is also called diversifiable risk. This unsystematic risk is that risk factors that are specific to firms. So this risk, we can also call it firm-specific risk. So this risk affects one firm and not the other. It affects one industry and not the other. It affects one economy and not the other. Are you getting it? So risks that are specific to firms, specific to individual stocks, is what we call unsystematic risk. All right. So here, for example, 2017, thereabout, when Bank of Ghana came out with that condition that banks should increase their minimum capital requirement from 200 million to 400 million Ghana cedis. This firms, a lot of firms were swallowed. A lot of banks, were swallowed because they could not meet the minimum capital requirement, as we know. So this particular risk resides within the banking sector and not in the food sector. So here, what it means is that if, for example, because of that factor or that regulation, and firms within the banking industry were not doing well, let's assume that firms within the banking industry were not doing well, then it means that if you have bought shares in any of the banks, for example, it means that shares will not perform. But if you have bought shares in any of the food industry, that shares may be performing, because that risk does not cross over to the food industry, right? So if you have done diversification, so that you have invested in the banks, you have invested in the food sector, you have invested in the gold sector, you have invested, then you can still benefit. So once we are dealing with systematic risk, an investor can benefit from what? Diversification. An investor can benefit from diversification once we are talking about what? Diversifiable risk. Because with proper diversification, because unsystematic risks affect one industry and not the other, and that way you can spread your investment income into different, so that when this is not doing well, the other areas you have investment to make up for it. So between the two main types of risk, systematic and non-systematic risk, the only one that you can, the type of risk that you can reduce with diversification is the unsystematic risk. The type of risk that you can reduce or minimize with proper diversification is what we call the unsystematic risk. As a result of that, unsystematic risk is called diversifiable risk because you can reduce that type of risk with proper diversification. Okay, so other firms, okay, for example, a firm earnings may decline because of a strike. So there's a strike in a particular firm. So the earnings of that firm will reduce because of the strike. It doesn't mean that all other firms, their earnings are reducing because all other firms may not be on strike. Other firms in the industry may not experience the same labor problem. So they will be performing while this firm may not be performing. So if you have invested in this firm that is on strike, you are not going to get the returns you may be expecting because of the lower returns resulting from the strike. But other areas that you have invested, you may be getting your promised returns. Okay. So in either case, the change in the firm's earnings is independent of the factor that affect the industry, the market, or the economy in general. Okay. So with unsystematic risk, that type of risk is what? Specific to the firms. It is not that type of risk that affect all industry the same, or it's not the type of risk that affect all the markets or the entire economy. No, it is specific. So don't forget that. Because this source of risk applies only to specific firm, it may be reduced through the construction of a diversified portfolio. I've said about that the risk that can be reduced, okay, if you want to reduce the risk associated with portfolio, then it is only the unsystematic risk aspect that you can reduce. You cannot reduce the systematic risk aspect. Okay. So total risk simply talks about the summation of systematic and unsystematic risk. When you bring systematic and unsystematic together, you get what we call total risk. But within the total risk, remember that it is only the unsystematic element within the total risk that you can reduce. Unsystematic risk, also called the diversifiable risk, can be subdivided into two. That is business risk and financial risk. Business risk and financial risk. When you talk about business risk, it is that risk that is associated with the nature of business you are doing. The nature of business that you are doing that results in the, can pose some kind of risk for you. The type of business you are doing can pose some kind of risk for you. Then when we talk about financial risk, here also is talking about that type of risk that is associated with the finances of the company in question. So for example, if you extend credit to customers, you sell goods to customers on credit, and the customers are unable to pay back what is due you as a company, you incur bad debt. So that bad debt is a typical example of financial risk. So you realize that this is under unsystematic because it is not all companies that may be granting or that may be suffering from this kind of financial risk. Borrowing is another example of financial. If you have borrowed as a company, are you getting it? Then at the end of the day, if you are not able to pay your loan, all right, if you are not able to pay your loan, what will happen? What will happen is that, one, the asset you use as collateral, they may take over it. So they're taking over some of your asset because you are owing and you're unable to pay. It's typically coming from financial risk, or even takeovers of your company entirely. So you are so indebted to the point that creditors have to take over your assets as a company. So these are specific to one business risk. All companies are not in the same line of business. So business risk belong to unsystematic. Financial risk also belongs to unsystematic. But when it comes to systematic risk, the one which is non-diversifiable, the one which happens to the entire economy now or the market, the types of risk we have under that is market risk. The risk that affect the entire market. Market here means the economy. It affects the entire economy. All right. Interest rate risk, the risk that arises as a result of fluctuations in the interest rates. Reinvestment risk, when you have invested and you have made some investment income, you want to reinvest that investment income. So that investment income you have reinvested, it might hit the rock. It would have been better if you had used that investment income to purchase something to enjoy. If you reinvest your investment income, the returns that you may be expecting on your reinvestment income may backfire. All right. And that is what we call the reinvestment rate risk. Then we have purchasing power risk. Purchasing power risk is that type of risk that accrue out of what? Inflation. All right, that accrue out of inflation. We know that inflation reduces our purchasing power. Inflation makes it difficult that if you had 100 cedis last year, what you could buy with it this year, you cannot buy the same stuff with the 100 Ghana cedis because inflation has caused the real value of the 100 Ghana cedis to reduce. Then exchange rate risk. Exchange rate risk talks about the risk that is associated with what? The depreciation and the appreciation of what? Countries' currencies. So these are all types of risk associated with what? Systematic. Be very consistent with these things and know where each belongs so that in the quizzes or mid-sem exam or main examination, you are not messing them up. So these have been defined for us. Business risk, as we said, is related to the nature of business. All businesses are not in the same line, so they don't face the same risk. All right, so I talked about that. Financial risk, all right, those risks, if you are in debt, you have some debt outstanding, it results in financial risk. If you owe some money to customers or you owe some money to your workers through wages, or you owe some money to your account payables, what we call the creditors, that also results in, so simply debt of any form is an example of what? Financial risk. Borrowing, I did mention that not long ago. And borrowing is the same as the financial leverage. It is all part of what we call the financial risk. Okay, so you take notice of all these important discussions. Okay. Then market risk, we are now on the systematic risk. Market risk is that risk that affects securities of that are traded in a certain economy. It affects the entire economy, and for that matter, every security that moves within or that is traded within that economy. All right. So when the price of securities fall as the market as a whole declines, so the entire that risk affects the entire market, so the whole market has declined. So for example, Ebola outbreak, if there's Ebola outbreak in a certain economy, it affects, it shuts down the entire economy. Like I made mention of COVID-19, but Ebola, for example, the food industry, any food industry, any food firm that uses meat, automatically the entire food sector has crashed, right? Security prices fluctuate, and the investor must either accept the risk associated with those fluctuations or not participate in that particular market. So when it comes to market risk, the risks affect the entire market. It affects the entire industry, or in the larger sense, it affects even the entire economy. So you have to understand the fluctuation rate of what? The market. And for that matter, ensure that you either adapt to the risk, you either accept the risk as it is, or you move out of that market. You don't trade within that particular market, which has suffered that particular risk. Interest rate risk, I just talked about that the, the fluctuations in the interest rate, We know that security prices mostly are influenced by the interest rate, especially bond prices. Okay, bond prices. They are all dependent on the current interest rate. So if the interest rate fluctuates, adversely, it can affect the prices of what? The bond. In terms of bond, for example, if the interest rate is going higher, bond prices fall. All right. If interest rate is going higher, bond prices fall. If interest rates are reducing, bond prices rise. So you have to, appreciate that. So that risk that emanate from fluctuations in what? Interest rate is what we call the interest rate risk. Then we also have reinvestment risk. I've talked about that. It is the risk associated with reinvesting funds that you have generated, that have been generated by an investment. So when you are reinvesting the funds that you have reinvested, the reinvestment fund, the funds that you have reinvested, it might not generate the returns that you had anticipated because of a couple of what factors. All right. Yeah. So that is reinvestment risk. Purchasing power risk, the risk that is associated or born out of what? Inflation. I have explained that. Exchange rate risk is that risk that is associated with what? Converting one currency to another currency. And this risk normally accrue to investors who hold international assets. Those who you are in Ghana and you want to invest in security denominated in US dollar. You want to invest in an asset that is denominated in euros, pounds. Then if there is steady fluctuation with the foreign currencies, for example, depreciation of the cedi, then you are going to suffer returns in terms of those fluctuations. Then we finally talk about efficient and competitive market. What do we mean by an efficient market? Economics teaches that markets with many participants who may buy or enter and exit freely will be competitive. So when you talk about competitive market, from the economics perspective, a competitive market is that market where it has so many buyers and sellers, there's so many participants, and you can enter the market freely and you can exit the market freely. Okay, so this characteristics of a competitive market defines what we call the financial market. So all financial markets, that is the market where financial assets are sold, we call financial market. They are very, very competitive because we have a number of buyers and sellers, and mostly entry and exit, even though it is not wholly free, it is not so free to enter into the financial market. Yes, there are a bit of restrictions, but the fact that the participants, buyers and sellers are many, makes financial markets competitive. So investment may participate freely. You may freely buy and sell your shares or sell your bonds. As and when you want to buy bonds, you are free to do so. As and when you want to exit by, selling it out, you want to enter into buying, these things are free. So participants, and there are many investors who always buy shares and bonds. So virtually anyone, whether a child or a grandmother, you may own financial assets or even savings account. You are free to do so. And so in financial markets where financial securities are traded, we can say that they are what? They are competitive. Many firms, including banks, insurance companies, and mutual funds, compete for funds of investors. So all these financial institutions that we have mentioned, all of them are chasing after us. We members of the general public, we are the prospective investors. They are chasing after our money. Insurers are saying we should come and buy the insurance product. They are interested in our money, premiums. Banks are saying we should come and deposit. They are also interested in our money. They are selling, even banks are selling certificates of deposit and some financial assets to us. A whole lot of things. Mutual funds are trying to sell shares to us. So all these firms are all interested in our money, all right? And for that matter, it is that competitive. It is that competitive. The financial markets are among the most competitive of all markets. They are the most competitive of all markets. Take notice of that. And they tend to be very efficient. We will look at what we mean by efficient market shortly. Security prices depends on future cash flows. So security prices, for example, price of shares, whether the price of this company's shares will go up or will come down, depends on the prospect for the company to make more earnings in future. Because the way we value securities are that we discount future cash flows into the present and we get the security, their prices, okay? So security prices, such as share prices, depends on the cash flows of the company that is issuing that particular shares. It also depends on how much dividend the company will be willing to pay in future. Now, if new information suggests that these flows will be altered, the market rapidly adjusts the asset price. So for example, today, if shares of MTN is say 1 cedi 20 pesos, and there is knowledge that in future MTN's earnings are going to be higher, MTN is going to make more profit, or there is an information or a belief that MTN shares is going to, or MTN is going to pay higher dividends going forward. So one, their earnings will be higher, and again, their, you know, they are going to pay more dividend. Then everybody will be willing to buy MTN shares in order to participate in the higher profit and the higher dividend that they will pay in future. Everybody will be demanding for MTN shares. I want to buy MTN. I want to buy MTN shares. And if more people are demanding for your product, what will happen to the price? The price will go up. Are you getting the point? The price will go up. On the other hand, if we get the impression that MTN, their profitability will fall, or MTN is not going to pay dividend for the next couple of years, then the company does not become attractive, and everybody will be willing to sell their MTN shares for somewhere else. And if everybody is selling, then the goods become so common on the market. And for you to get a sale, you have to reduce the price. Are you getting it? So that is how, so information about future flows, such as dividends, distributions, and future cash flows, those informations, the moment we get this knowledge of this information, they are incorporated, the market automatically incorporate them, and it's reset a certain price for the company. So a market is efficient if all of these information are incorporated into the share price of what? The security. That is what we call efficient market. So an efficient financial market implies that this asset's current price embodies or incorporates all known information concerning the potential return and risk associated with what the particular asset. So all information about the asset, if they are incorporated into the share price, then we say that that particular asset or that particular market is what? Efficient. If an asset, for example, stock is undervalued, a stock that is undervalued means that the asset is selling cheap. It means that shares is selling cheap and therefore having excessive returns. For example, the asset ought to sell at 500, but it's being sold for 450. If it is being sold for 450, then it means that I can buy it cheap and going forward sell it higher price to make excessive returns. So if an asset is undervalued, that is to say that an asset is having or distributing excessive return, investors will seek to buy. Okay, they will buy an asset that is selling cheap. And once they are all, more people are buying that asset that is lowerly priced, demand will shoot up. Demand for the asset will shoot up. And once demand for the asset shoot up, price of the asset will also be raised. Because wherever demand is higher, price tend to go up. And the undervalued asset will be corrected. The price will shoot up and the returns will what? Drop to normal, to the normal return that is expected. In the same way, if an asset is overvalued means that the asset is overly priced. It is selling more than it ought to sell. All right. Therefore, the returns is very small. The asset is too expensive. People believe that the market believe that the asset is overly priced. It is not fair. Then what will happen is that those who are holding their asset, they'll begin to sell it because they know that very soon the market price will drop, the correct price will come. So they will sell their asset at that high price. You know, they will sell their asset. And once everybody offers to sell their asset, what will happen? The price will drop. Because whenever we all supply our goods to the market that we want to sell, we have to reduce the price in order to get a sale. So if asset is overpriced, investors will offer their securities for sale because the returns are not attractive. And when they all supply their securities for sale, the price will eventually drop. And when the price drops, the returns will begin to what? Pick up. Right. So the fact that there are sufficient investors who are informed means that security price will, one, reflect the investment community's consensus regarding the asset true value. So all about efficient market is that we need information. Investors must have what? Information. They must have information about the value of what? The asset. The asset must be correctly what? Priced. Once they have information, that information will be incorporated because investors act on the basis of information. How do they act? They act by making decision of either buying and selling. And through the decision they make of either buying and selling, through that act of buying and selling, the price corrects itself. The price corrects itself by automatically, that their action means that the information, they are acting on the basis of the information. And once they are acting on the basis of information and they buy and sell and the price corrects itself, then it means that the new price would have embodied in it the information that has prevailed on the market. And if a market, a financial market, exhibits this characteristic, then we say that that market is what? Efficient. So in conclusion, although security prices and returns are ultimately determined by the interaction between buyers and sellers, there is little information or there is individual can do, a single individual can do to affect security price. So it is the host of investors, their action that can affect the share price, not the act of a single investor. Instead, the investor should select among alternatives to build a portfolio that is consistent with his or financial goals and willingness to bear risk. That is, the investor must allocate his or her resources to construct a well-diversified portfolio that over time meets the reason for saving and postponing current spending. So this is apparently the end of our first lecture.